Japan's economy is a fascinating study. While the rest of the world has grown so much over the last 30 years, especially its neighbors China and South Korea, Japan has ended in 30 years of deflation and stagnation. To illustrate how little growth there is in Japan, in 1994, Japan's GDP was at $4.9 trillion. At the end of 2021, it's at $4.9 trillion, which still makes it the third largest economy in the world. But as wages kept falling, debt kept rising, and its people kept aging, the future does not look good for Japan. I mean, it has gotten so bad that in a desperate attempt to turn the situation around, the Bank of Japan has bought 80% of all ETFs and 70% of government debt, making it the single biggest shareholder of corporate Japan. And what's fascinating about Japan's case is how fast and abrupt the downfall was. It was only in the 60s and 70s that Japan experienced 400% growth in 15 years, while dominating the export market, flooding the Western world with its cheap and innovative cars, computers, and TVs. In the 1970s, the double-digit growth ended with the oil crisis in 1973 and 1979, and in the 1980s, abnormalities began to occur in Japan's economy, leading to its massive stock market and a real estate bubble that burst in 1990 and 1991 respectively. So today, we're going to look at these abnormalities, examine how did it happen, and how Japanese policymakers are combating this phenomenon unsuccessfully so far. So, the 1980s was considered as the golden age of Japan's economic miracle. Japan was the second largest economy in the world, and GDP still grew at a healthy 4% per year. Easy monetary policy fueled massive investments all across the country, and Japanese companies dominated the American market to the point that Americans were losing their jobs, with the media endlessly portraying Japan as a growing superpower that threatened America's dominance. But as I said before, the 1980s was when abnormalities began to occur in the Japanese economy. Most people like to blame easy monetary policy and low interest rate environment for the bubble. And while that isn't wrong, these structural weaknesses are what preceded the bubble and weakened the Japanese economy. You see, Japan's economic miracle was caused by several factors. First, it implemented a priority production strategy that concentrates valuable resources in Japan's most important sectors. How? They did this with a monetary technique known as window guidance, where the Bank of Japan orders private banks to create credits for companies that they deem important for growth, which mainly comprises of manufacturing companies. This strategy worked spectacularly for Japan in the 1960s because there was a central authority that ensured capital was allocated efficiently to industries with a lower capital cost, so that scarce funds can be used effectively to increase economic growth. This scheme allowed for massive investments in manufacturing that helped to double the size of Japan's economy in less than 7 years in the 1960s. But while this program is considered a massive success, industries that weren't prioritized suffered from shortages of investment funds. It essentially creates a dual economic structure. Industries that received special treatment were large, very efficient, and highly productive, with higher wages and better working conditions. While industries that don't receive the same special treatment were small, inefficient, and unproductive, with lower wages and poorer working conditions. Industries that were considered privileged include cars, electronic products, computers, and semiconductors, while those that were underprivileged include small businesses and raw material producers such as glass, paper, basic steel, and processed food. There was a big gap in competitiveness and productivity between heavy industries and big businesses and small businesses that were underprivileged. This was fine during the 1960s, as the privileged big companies were so efficient and productive that it was able to prop up the economy as a whole. But problems began to surface when economic growth started to wane. Even today, this problem that takes root in the 1960s still haunts the Japanese economy. Another problem that precedes the asset bubble was in its banking system. You see, in the 1950s, Japan has a big problem. There was a shortage of investment capital caused by its shortage of savings. This makes raising funds from the stock market or bond markets difficult because no one was saving, let alone investing in the first place. As a result, Japan relied much more on banks to fund business investments. Banks often borrowed heavily from the central bank, and businesses borrowed heavily from banks. In the 1950s and 60s, this was risky but it worked really well. Thanks to the massive loans that banks provided, Big companies like Toyota, Honda, and Mitsubishi began to thrive. In the 1980s though, things were very different. Japan no longer has a saving shortage problem thanks to its ever-growing middle class. And big companies don't need as much bank lending anymore because it's easier and essentially cheaper for them to raise funds from the stock market or the bond market. What happened was that banks began to lose their best and largest customers, and they frantically searched for new borrowers. These new borrowers, however, were mostly construction and real estate companies that took advantage of rising land prices. They used their real estate as collateral, and the market values of these real estate were based on a very optimistic future assessment. This in turn fueled the largest asset bubble Japan has ever seen. What makes this even worse is that Japan's banking system had a policy known as the convoy system. The convoy system protected banks from bankruptcy with emergency lending and merged troubled banks with healthier banks. It was vital to Japan's economic miracle as it protected the banking sector from instability that might lead to a systemic collapse. This is also why, for 40 years from the 1950s to the early 1990s, not a single Japanese bank went bankrupt despite its massive lending program. However, this convoy system creates a problem of moral hazard. Banks started to lose their discipline, investing in high-risk assets and counting on government bailouts in case things went wrong, which went on to fuel the massive asset bubble. In the 1960s, healthy banks were oftentimes willing to take on these bad assets. But when the crisis happened, even relatively strong banks were unwilling to participate in such bailouts because the scale of the crisis was just too big, essentially putting an end to the convoy system. It is fascinating to see that economic policies that helped Japan to become an economic miracle were also the very same factor that caused its downfall. The bubble started in the mid-1980s, as the economy began to weaken and banks lent money without considering its risk, fueled by easy monetary policy that made loans cheaper than ever. The BOJ, along with the rest of the world, first started lowering interest rates in 1979, in response to the second oil crisis caused by the Iranian Revolution. Meanwhile, the second time Japan lowered its interest rate was after the 1985 Plaza Accord. The Plaza Accord was an agreement between the G5 nations, France, Germany, US, UK, and Japan, to depreciate the US dollar relative to the Japanese yen and German Deutschmark. When the yen finally appreciated, Japanese citizens got even wealthier and bought up foreign assets to flaunt their wealth. But at the same time, it created a major shock for Japanese exporters who saw their products got more expensive to their customers. To offset this shock, the Japanese government lowered interest rates even more, along with an expansionary fiscal policy to boost the economy. The massive stimulus went to fuel the asset bubble to new heights, and economists argue that the Plaza Accord was when the bubble really took off. To give you some numbers on how big the bubble was, the Nikkei 225 index went from 10,000 yen to 40,000 yen in 5 years. And on average, stock market returns exceeded 20% per year with a 44% increase in 1986. Land prices nationwide increased by 50% on average, with a 69% increase in 1987. Major cities like Tokyo and Osaka saw housing costs doubled in 2 years and tripled in 5 years. Japan's real estate bubble is quite similar in size to the early 2000s housing bubble in the United States, where major cities like New York, Miami, and San Francisco saw housing prices doubled or tripled. The phenomenon fed on itself when asset prices began to rise and investors used those inflated assets for collateral to borrow more money, which they used to buy more inflated assets. It created a wealth effect and people were feeling richer, spending lavishly on consumer items and investment products. With the appreciation of the yen compared to the US dollar, Japanese companies began to invest heavily in America. Commercial real estate acquisitions in the United States by Japanese companies reached $10 billion in 1988, an increase of more than 1,000% since 1983. The consumer electronics company Sony bought Columbia Pictures, the Hollywood film studio, for $4.8 billion in 1989. Mitsubishi, the car company, bought $846 million worth of controlling shares for Rockefeller Center, a famous cultural landmark in New York. There was a genuine fear at the time that Japan would buy up America to the point that the government had to step in. There was an indication that an unnamed Japanese company was on the verge of buying Chicago's Sears Tower, the ultimate real estate trophy and the world's tallest building at the time, only to have the deal squashed by Japan's finance ministry, fearing the backlash it would receive. In the early 1990s, the BOJ deemed that the low interest rate environment was unsustainable, and there was concern about rising inflation. So it drastically increased interest rate from 2.5% in May 1989 to 6% in August 1990. Stock prices started to decline in the early 1990s. The Nikkei 225 index fell to around 15,000 yen, falling 60% from its peak of 40,000 yen. The economy was especially hit hard by the collapse of the real estate bubble, which spawned a wave of loan defaults. Nationwide urban land values declined 28% on average throughout the 1990s. In the 6 largest Japanese cities that saw housing costs triple, land prices declined by 62% and commercial real estate declined by 78%. More importantly, the asset bubble exposed deep structural problems in Japan's financial system. The collapse of the bubble left many Japanese banks with a huge volume of loans that were not likely to be repaid, as stocks and property were widely used as collateral. Government practices like the convoy system were criticized for causing moral hazard, and the collapse also exposed questionable accounting practices that allowed banks to hide non-performing loans instead of writing them off. The burst of the bubble marked the beginning of Japan's economic crisis. When the government realized what had happened, they immediately lowered interest rates and implemented a combination of tax cuts and spending increases. But they have to do this against a backdrop of aging population that would contribute less and less to the economy, which is a ticking time bomb. Now, the increased spending in particular is quite a gamble. If the stimulus package proved effective, Japan's economy could return to sustained economic growth. But if the economy didn't grow sufficiently to increase business production or consumer confidence, then Japan will end up with a very high debt burden, which it does have now with its 270% debt to GDP. The economy did show signs of recovery in 1995 and 96, but the 1997 Asian financial crisis plunged Japan into another crisis. Now actually, Japan doesn't really get affected by the Asian financial crisis in itself, but Asia was and still is one of Japan's largest trade partners. In 1996, Asia accounted for 44% of Japanese total exports. In 1997, the share declined to 42%, and by the end of 1998 to 35%. In 1998, Japanese exports to countries damaged the most by the crisis declined dramatically. South Korea 36.4%, Thailand 30.7%, and Indonesia 54.5%. Japanese banks also had large exposure to these countries. In 1996, 62% of all international lending from Japanese banks was to 8 countries that were hit the hardest by the crisis: South Korea, Thailand, Indonesia, Malaysia, the Philippines, Taiwan, Hong Kong, and Singapore, causing many loans to go bad. The BOJ continued to lower interest rate until the year 2000, when it reached 0%. And unfortunately, Japan failed to reach sustained economic growth since the 1990 crisis. The decade from 1990 to 2000 is now known as the Lost Decade, a period of economic stagnation in Japan which became one of the longest-running economic crises in history. But the crisis doesn't end there though. In the 2000s, deflation became Japan's most pressing concern. Wages were declining, and short-term interest rates remained trapped near zero. The economy did grow a little bit at around 1 to 2% per year. However, this growth came from more export expansion rather than rising domestic consumption. The deflation has caused Japanese people reluctant to spend money. The export-led growth is fine and all, but when an economy is relying so heavily on exports, it became dependent on the rest of the world. And again, the 2008 financial crisis proved this. Even though Japanese banks mostly don't participate in the financial boom and don't have many toxic assets, unlike many other countries, it was the only advanced economy that experienced negative growth in 2008 and continues to contract sharply in 2009, with industrial production fell rapidly across all sectors. From 2010 onwards, Japan's biggest problem is its aging population. Japan is the oldest country in the world, with a median age of 48 and almost 30% of its citizens are age 65 and above, making up around 38 million people, larger than the entire population of Canada. And the population has rapidly shrunk year after year since 2011. This is a worrying problem, because the declining number of young people has created a shortage of workers and has led to decreasing productivity. An aging society results in challenging budget conditions, with more money allocated to healthcare and social welfare programs. Not only that, there's an indication that poverty among Japan's elderly is growing. The poverty rate of older people aged over 65 is 19.6%, compared with 13.5% on average in OECD countries. Meanwhile, mild deflation has also persisted. And in response, the BOJ has implemented extreme quantitative easing programs by not only buying bonds but also stocks, owning 7% of the entire stock market. And the side effects of these radical monetary policy programs are getting out of hand. In 2022, amidst a global surge in energy prices and economic slowdown all over the world, Japan has now reached a 2% inflation rate. This should come as a relief for the BOJ. But the idea of rising prices is so foreign in Japan that the people are not happy with it, especially when wages are still stagnating. The governor of the BOJ, for example, had to publicly apologize when he said the people should just get used to rising prices. Moreover, the existing inflation isn't caused by domestic policy but by macroeconomic conditions, and with wages still stagnating, things are going to get painful for consumers, which will likely reduce consumption even more, which is the last thing that Japan needs. Now, if you want to know how Japan got rich in the first place, check out my video on exactly that topic. This is Doverhill, and see you next time.